Okay, let's get started. Today's topic is financial planning and growth. Last week we talked about financial statement analysis, how to read financial statements, namely balance sheet and income statement and cash flow statement, how to read them, and how to analyze financial statements. We didn't discuss in depth, but we at least got some taste for financial statement analysis. This week, we are going to have the first application of financial statement analysis, namely financial planning. If you analyze financial statements, then you should be able to use your knowledge and your skills in financial statement analysis to apply in financial planning. Financial planning is nothing but looking at the future in terms of financial statements. What the future financial statements will look like. That's what financial planning is all about. What is financial planning? I already explained to you. Financial planning and models, a first look. Those are the two sections of the chapter that you are required to read. All other parts, they are important and they are useful, but for our purposes, I'm not going to ask you to read. Okay? Elements of financial planning. At times, students, my former students, were thinking that financial statement analysis is one thing and financial planning is another, but they are not. Financial statements and financial planning are very closely interconnected. Let me draw a very simplified balance sheet. Here's current assets and here's current liabilities. And here's fixed assets and long-term debt and equity. That's total assets, total assets. Financial planning is nothing but what the future fixed assets are going to be. And what the current assets minus current liabilities, that is net working capital, will likely to be in the future. What's the long-term debt position the company will have in the future, and what equity position the company will have in the future. In other words, the future shape of balance sheet is what we are trying to develop. That's financial planning. And this process involves all four functions of corporate finance, financial management. One is capital budgeting. By capital budgeting will determine how much of fixed assets and what kind of fixed assets you are going to have in the future. Capital structure decision, long-term debt. How much long-term debt you are going to have. And dividend decision, how much equity you are going to have. And net working capital decision will determine current assets and current liabilities. So unless you know financial statements, you will not be able to do financial planning. in order to do successful financial planning, you will have to understand how financial statements, especially balance sheet, will look like. Where balance sheet, how the balance sheet is going to, balance sheet items are interacting with each other. Financial planning process, I explained it already. Short-term planning is for about 1 year, and long-term planning 2 to 5 years. Role of financial planning helps management see the interactions between decisions. I already explained to you. Gives management a systematic framework for exploring and capitalizing on its opportunities. Helps management avoid surprises by identifying possible outcomes and making contingency plans. Helps management determine if goals are feasible and internally consistent with one another. And this part is particularly important. Unless you look at this pro forma future balance sheet, you wouldn't be able to know whether or not your decision is internally consistent. That will become very clear in a few minutes. Okay. The output of financial planning model is pro forma balance sheet and pro forma financial statements. Especially pro forma statements will show the amount of financing needed to pay for the required assets. At the moment, you may not be able to understand, but as soon as we do the case study, you will get to know for sure. It gives a projection of the internally generated funds. It computes the plug variable, as also known as external financing needed. And management has to decide what type of financing will be used to make the balance sheet balance. Okay. Having said that, that's not important. Let's look at this case study. Okay. Case study, you have to participate. Today, I'll speak a little because my voice is not good enough. You speak today, okay? Look at this balance sheet, the left-hand side one first. It's year 2009. The company is making sales of 500, okay? 500,000 or 500 million, whatever it is. Very simplified balance sheet. The company's sales level is 500, and the company's total asset is 605. I want you to draw this picture in your head, okay? Think about this company. You are hired by this company to give future projection of the company. The company manager asks you to give advice. The company's cash position is 5%, and that cash position is generally consistent with or proportional to the level of sales. It's 1% of net sales. Ordinarily, most of the current assets and current liabilities, they are moving proportional to net sales. As net sales go up, assets will go up, especially current assets and current liabilities. So cash position is 5% of net sales. That's 5. Accounts receivable, $90, and that's 18% of net sales. And that 18% is very consistent over time. Inventory, 105. That's again very proportional to net sales. So total current assets would be 200. Get it? 200 out of 605 total assets. Machines and equipment, 140, and that is also assumed to be proportional to net sales. As net sales go up, machines and equipment also go up. Land and buildings however, assumed to be fixed. Okay? As sales level go up, you cannot add land or you cannot add buildings that easily. Okay? Land and buildings, they only grow in steps. The same level for several years, and then there's a big jump, and same level again for several years. Okay? Left-hand side, it's 605. Right-hand side shows you how the left-hand side is financed, where the money came from. Okay? Very interestingly, the company uses $0 of short-term borrowing. There is no note payable. No short-term borrowing. Accounts payable, that's trade credit, of 55. Other current liabilities, 30. And accounts payable and other current liabilities, they are moving hand in hand with net sales. Total current liabilities of 85. Long-term debt is 210, and the company has decided to maintain long-term debt as is. In other words, the company doesn't want to increase long-term debt or doesn't want to decrease long-term debt. Long-term debt stays there. Okay? The company does not want to issue new debt. The company doesn't want to pay back long-term debt either. So it will stay at 210. It's almost fixed. Net worth is common stock, capital surplus, plus retained earnings. Okay? The company's equity of 310. So total of 605. Do you have a picture of this company? Balance sheet? Have some picture of the company. If you look at the balance sheet, oh, okay, this company, okay, current asset of 200 and total asset 605 and net worth of 310. Long-term debt is about 200. Okay, have that picture. In terms of ratios, three key ratios. Current ratio of 2.35. For each dollar of current liabilities, you have $2.35 of current assets. Quick ratio. For each dollar of current liabilities, you have $1.12 of quick assets, cash and marketable securities plus accounts receivable. So the company seems pretty solvent. The company doesn't have any problem of paying short-term debt. Debt to equity ratio is 0.95. For $1 of my money, the company uses $0.95 of someone else's money. So the company seems pretty healthy and stable and strong. Do you have this picture in you? Okay, you have to have that picture before we go on to the next step. Right. Okay. The company wants to grow in 1 year 70% growth in sales. Sales level was 500 and it wants to increase the sales level to 850. Okay? In 1 year, the company wants to grow 70%. So this is just extraordinary kind of thing. 70% growth in 1 year. Okay? And the company expects to have net income, net profit after tax of 34. And out of 34, no dividend is going to be paid. 0 dividend. So 34 will be retained within the firm. It will be added to the account called retained earnings. Okay? 34 will be added to retained earnings. So equity position will go up by 34. Do you see this? Okay. Then let's fill out this pro forma balance sheet, pro forma, projected balance sheet. Okay? We want to create this pro forma balance sheet. And How I do it, I usually do it from the left-hand side, from top to bottom, and then move sideways and bottom to up. So cash. It's moving hand in hand with net sales. So 1% of net sales, 8.5, right? So put down 8.5. Accounts receivable, that's 18% of net sales. So easy, 153. Inventory level, 21%. So 178.5. Add them up, you have current assets. Easy. Machines and equipment, 28%, 238. Land and buildings, this is fixed, assumed to be fixed. The company doesn't want to add, at the moment, additional land or buildings. So it will stay at 265. So next year's balance sheet, left-hand side, will be total of 843. Do you get it? Do you get the picture? Now here's something you have to understand. The company wants to increase net sales from 500 to 850. So net sales increase of 350. And somehow, when you look at the pro forma balance sheet, the left-hand side, you see the total assets go up by 605 to 843. So total assets go up by 238. So this one tells you something very important, very simple and obvious, but a lot of people don't have this linkage between net sales and total assets. When you want to grow in sales, you have to invest in assets in order to grow. Growth is not possible without investing in assets. When you want to grow in sales, when you want to have more sales in the future, you will have to increase the size of your assets. Unless you increase the size of assets, you cannot have growth in sales. So there is a very strong connection between net sales and total assets. If you want to have growth in net sales, okay, you will have to invest in total assets. Investment is necessary to have growth. Without investment, you cannot grow. In order to grow, you have to make investments. I want you to have this clear linkage in you. You have to understand this. A lot of students, even business school students, they don't understand the linkage between this, between net sales and total assets. When net sales go up, total assets will have to go up. There is no free lunch in finance. Net sales go up, and in order for net sales to go up, you have to increase total assets. You have to invest in total assets. If you have investment in total assets, then you will have net sales growth. You get it? Okay. If this is the case, then you will have to find out how $238 increase in total assets are financed. That's the right-hand side of the balance sheet. So let's look at the right-hand side of the balance sheet. total assets, total liabilities and equity of 843. It should balance. If they don't balance, then you are making a mistake. So they should balance. And going back up. Net worth. I put down 344. Why 344? Where did I get this number? Huh? Who wants to answer? Sora. 34 is added to this, right? So previous net worth, previous equity plus retained earnings, okay? So equity position will become larger because of net profit being retained. The company retains all the net profit within the firm, so retained earnings of the equity part goes up, therefore net worth goes up by 34, and it will become 344. Okay, 344 is 310 plus amount of earnings that are retained. So net worth is 344, and long-term debt is assumed to be fixed. The company has made a decision not to increase or decrease the long-term debt. So long-term debt stays the same. Net worth is 344. Therefore, if you subtract these two numbers from 843, you will have 289. Get it? Current liabilities of 289, and you have other current liabilities and account payable. They are proportional to net sales. So write down 11% of net sales, 93.5 as accounts payable, and 6% of 850, that's 51 for other current liabilities. And subtract these two, you will see this plug variable. Plug variable. That variable is unknown, and you are trying to find. That's why I put the number in red. Okay? It's a plug variable. Okay? Subtracting these two, you have 144.5. Right? Now, having said that, now we know how the company financed 238 of total assets. Total assets go up by 238, and items over here on the right-hand side must have gone up to finance 238 increase in total assets. The first obvious thing is retention. Earnings retention of 34. Right? There is no long-term debt increase, so forget that. Accounts payable. Accounts payable and other current liabilities. They have gone up by $59.5. Yeah. And borrowing of 144.5. They add up to be 238. You see it? 238 investments are needed, and to finance the investments, the company used earnings retention of 34, and accounts payable and other current liabilities increased by 59.5, and borrowing of 144.9. Look at this. Current ratio was 2.35. But after this massive growth, current ratio has come down to 1.18, substantial decrease in current ratio, and another substantial decrease in quick ratio, it's 0.56. For each dollar of current liabilities, the liabilities that come due in 1 year, the company has only 56 cents. The company may be subject to greater level of liquidity risk or solvency risk. May not be able to pay back its current liabilities. Debt equity ratio has gone up from 0.95 to 1.45. So by looking at the ratios, you can tell that company's liquidity position has deteriorated. Liquidity position has become worse, and leverage ratio has gone up. So risk of bankruptcy increases. That's the kind of information that you are looking for when you do financial statement analysis. Now, the reason why liquidity position has worsened and leverage ratio has gone up is because of the structure of financing. See, retention, it's my money or someone else's money? Okay, let's call that my money. Accounts payable and current liabilities, my money or someone else's money? Other people's money. Borrowing, of course it's other people's money. That's not my money. So in terms of my money versus someone else's money, it's almost 1 to 7. 34 is the only, 34 out of 238. How much is 34 divided by 238? How much is it? Anyone has a calculator? Young. June, what's the 14? 14%. Okay. It's only 14%. 14%. And 86% are someone else's money. My money versus someone else's money. It's 14 versus 86. Additional 238 is financed with 14% my money and 7 times of someone else's money. Obviously, that's why debt ratio has gone up. Earnings retention, is it a long-term money or short-term money? No? Retained earnings, is it short-term or long-term? It's long-term. Equity is a long-term financing, so long-term. Current liabilities, that's short-term, right? Borrowing, that's short-term. So in terms of long-term versus short-term, it's, again, 14% versus 86%. So the company uses 7 times greater short-term money than long-term money. And obviously that's why this liquidity position has become worse. Any questions? Do you see it? Because of growth, the company will have to invest in assets. And investing in assets need to be financed, and financing, primary source of financing was borrowing and short-term other people's money, and therefore debt ratio and liquidity ratios has become worse. That's the kind of pain that you will have when you are growing very fast. Of course, positive growth is needed for all businesses. For business to survive, you have to grow. But too fast growth, too much growth may be not as good as you, not so good. For a company to grow, at the level that will not affect current capital structure, current debt ratio. How much can the company grow without affecting current capital structure is called sustainable growth. Sustainable growth rate. Don't ask me why it is computed this way. Just take it for granted, okay? 1 minus theta. Theta is dividend payout ratio times net profit after tax during time period T divided by equity, T minus 1 equity. So for this company, called ABC, net profit after tax of 34. Net profit after theta is 0, so it's 1 times net profit after tax of 34 divided by equity of 310. So please calculate this number. Yeah? A little more than 10%, right? Can you calculate it? $1016. Yeah. In terms 1096. So approximately 11%. 11% is, if the company grows by 11%, the company's debt ratio will still the same. Okay? Debt ratio will be about the same. But the company is growing at 70%. Okay? So too much growth is sometimes painful. It's called growing pain. It's called growing pain. My daughter, when she was 8 or 9, very young, one day she said that she's in pain. So I asked her, where do you feel it hurts? And she says, everywhere, everywhere. By the way, she is very tall. Okay, 5'11" or 5'10", 177 centimeters. She's as tall as I am. She says every part, everywhere it hurts. So I thought that, oh my goodness, she is in big trouble. So I brought her to her doctor. And her doctor examined her and said, Mr. Choi, it's usual thing. Just give her a couple of Tylenol, the painkiller, and she'll be okay tomorrow. I thought that she was going to die. She feels pain everywhere, and you are you are telling me that you give a couple of Tylenol pills. Yeah, that's all you need. And he said, this is what we call growing pain. Growing pain. Her bones are growing much faster than her muscles. Bones are growing faster than muscles, then you will feel that pulling this pain, muscle pulling pain. So I gave her a couple of Tylenol pills, and the next day she was okay. Corporations have this growing pain too. When the company grows too fast, then it will have pain. Sometimes that pain is too much for the company not to be able to handle. But anyway, in our example, the company's debt ratio has gone up, and liquidity position has deteriorated because of too much growth. So too much growth is not necessarily a good idea. It has its own pain. Okay? Now, having said that, as a financial manager, this may be too much. Borrowing of 144.5, that may be too much. The company has never had any borrowing, short-term borrowing, but all of a sudden the company has large amount of short-term borrowing. That's too much. Can we do something to reduce or do something to have less pain? Okay? Instead of having to borrow 144.5, is there any other way to borrow or to raise 144.5? Other possibilities, other alternative financing tools. Can we think of anything alternative to borrowing 144.5? Huh? Okay, okay. I can erase that. Issue new shares. Stock issuance. Issue new shares to raise money and use that instead. If you issue new shares, that's my money, okay? So debt ratio is not going to be as bad as this, and short-term position may not deteriorate as this. So issuing new shares. Anything else? Anybody else? Okay. You would like to take investments from other companies. So it's fairly similar to issuing new shares to other company. Okay. Grants from government. Okay. Okay, that's possibility. But what kind of grants? This company goes to the government and say, please give me grant. Then the government will say, why? What for? Why should I? Huh? Growth is for your own benefit. If the company is a fast grower, why should the government help growth? For the country's economy. government can't do all those things. Okay, anyone else? I want you to think. All kinds of innovative ideas I would like to welcome. Okay. Sell off assets. Especially the assets that are not in use, that are currently unused or unnecessary land, some idle lands and property you can sell. That's one possibility. By selling assets, you reduce land and buildings. Okay, that's how you reduce the amount of borrowing. Okay, that's good. Anyone else? Huh? Exchange? Okay. In some sense, it's included here. Issue new shares. Issue new shares and give it to other companies so that other company can give you money. Okay. It's called mergers and acquisitions. Okay. You want to go into M&A? That's possibility, but let's put that in this category. Issue new shares to other company. Anyone else? They may change the long-term debt policy. Increase long-term borrowing. Issue new long-term debt. That's a possibility. That will not help debt ratio, but that will help certainly liquidity positions. Anyone else? Reduce the sales growth. Well, that's possibility, but we at the moment the case is asking you the company wants to have this much growth, okay, and how to finance this growth. So it will be ideal if the company can bring down its growth rate to a more manageable level. That may be ideal, but at the moment the company wants to grow at 70%, and you're supposed to find a way to help the company grow at 70%. Look at this very carefully. Issue new shares, that's the right-hand side, bottom of it, right? Issue new shares to increase net worth, and that will reduce borrowing, okay? However, issuing new shares, we'll talk about it toward the end of this semester. Issuing new shares is very difficult. Very difficult for companies to issue new shares and raise money. It's something you can talk about it, but it cannot be done that easily. Okay? Companies do not have access to new issues market. Okay? So that's practically speaking not easy for many of the companies, especially this kind of small firm that's impossible. Sell off assets. For a really fast-growing firm, selling off assets may be difficult because the company is a fast-growing firm. There is no asset that is currently unused. So this is limited. Increase long-term borrowing. Yeah, that's possible, but debt ratio wouldn't improve. But one possibility is I get the idea from this selling of assets. Your name was? Chun Kwang-hee. I got the idea from Chun Kwang-hee. Chun Kwang-hee said, sell off some assets. The company does not have much assets to sell, but I come to think of it. The company has maintaining inventory of 178. And the company is also carrying accounts receivable of 153. If that's the case, why don't the company do make some changes in account receivable policy and or inventory policy? The company make changes in inventory policy and receivable policy to reduce the level of accounts receivable and reduce the level of inventory. If you can reduce the level of these two, then that will reduce total assets, and that will reduce total amount of financing needed, and that will also reduce borrowing level. So one exercise between now and end of today's class, I would like to do this exercise. Let us assume that cost of goods sold is 80% of net sales. Assume that cost of goods sold is 80% of net sales, and suppose the company decides to improve inventory management. Such that inventory turnover, ITO, inventory turnover becomes 5. Currently, ITO of this company is sales of 500 times 80%, that's cost of goods sold, divided by inventory of 105, and that's 3.1. Currently, inventory turnover is I think I'm right. I take the back, 3.81. Currently, inventory turnover is 3.81. So for each dollar of inventory the company carries, the company is generating $5 of, for each dollar of inventory the company carries, the company generates $3.81 of sales. Now, the company wants to improve its inventory management such that it will generate $5 of inventory, $5 of sales instead of $3.81. In other words, it wants to improve inventory management efficiency such that inventory carrying, the amount of inventory that the company has to carry can be reduced. In other words, investment in inventory can be reduced such that it will have less amount of borrowing. Now, what I'm asking is find how much the company has to borrow to finance 70% growth. Right now, the company has to borrow 144, but if inventory turnover can be improved from 3.81 to 5, how much should the company borrow? And how much savings in borrowing can occur because of this decision? I want you to take 5 minutes with your friends, talk about it, and tell me. You have to discuss. Discuss this with your group members.
500 is tourist and remaining is inventory.
No.
What is this?
Net sales. Net sales of this year. Yes. No. 800. 850. Okay, let's get back. So, how much borrowing is needed? What's the new level of borrowing? 102. Okay. 102. Anyone else? 102. Okay, this is the right answer. Okay. It's very simply, if you would like to have inventory turnover of 5 in 2010 with net sales of 850, cost of goods sold is 850 times 0.8 divided by inventory. How much inventory you are going to have? That's, you would like to find the amount of inventory, and if you compute inventory, it will be equal to 136. 136. Right? So instead of 178.5, 136 is plugged in here, and you go back up, you will find that borrowing will be smaller. So inventory level is, we're comparing 178 and 136, it's 42.5. So you can save 42.5 of inventory. Therefore, that amount of saving will be able to reduce the amount of borrowing by 42.5. And therefore, amount of borrowing is 102. Okay? So by looking at this, you can see that working capital decision or investment decision or financing decision, they all affect the future pro forma financial statements. And that's financial planning. Financial planning involves how investment decisions, financing decisions, the working capital decisions affect the future shape of the company's balance sheet. You get it? Okay, that's about financial planning. One last slide that I would like to show to you is sustainable growth rate. This is the sustainable growth rate. And I showed you that it's, by definition, you take it as given, 1 minus payout ratio theta times net profit after tax divided by equity of the previous year end. You can decompose this thing. You can decompose that thing. Net profit after tax divided by net sales. What does this number is called? Net profit margin. Net sales divided by total assets. That's total asset turnover. And total assets over equity. That's 1 plus debt to equity ratio. And equity T divided by equity T minus 1, that's equity growth. So if you look at the components of sustainable growth rate, you have 5 components. Retention, earnings retention. The more you retain as part of your net profit, the faster you can grow. The faster you can grow without changing the company's capital structure. The more profitable, you can grow faster. The more efficient in total asset management, like inventory, you can grow faster. This is fixed. You have to issue new shares or change your leverage ratio. You can grow faster, okay? Any questions? Okay, that's all for today. This is the end of part 1 of financial management. Part 1 of financial management is financial statement analyses and financial planning. On Monday, we'll get into time value of money calculation. It's compounding, discounting, and all kinds of computations. You need to bring your calculator from Monday, okay? That's all for today.